Erin Gibbs, last year was a great year for stocks, but all we've gotten this year so far is a lot of volatility. So what do you expect for the rest of 2015? More of the same?
Basically, yes. I have two concerns about the market for this year. One, we're going into the market trading at 17 times forward earnings. This is the highest we've seen in over 10 years. And so I definitely see this as like a 5 to 10% premium to where we typically have been on valuations. But on the other hand, we don't have the earnings growth to offset those expectations, those high valuations. Right now, we're looking at about 7% earnings growth, which is less than last year. So net, looking at about 7 to 8% earnings growth, 10% premium, I'm looking at a fairly flat market. My forecast is about 5% up for the end of the year.
But is that better than the returns for the rest of the world? Is the U.S. still the best house in the bad neighborhood? So keep your money here as opposed to going to Europe or Japan or the emerging markets?
That's exactly why I see the valuations. That's a great question. It's because the U.S. is the best in a bad market that we're seeing these valuations. We're clearly seeing the flows into the U.S. markets, and the U.S. is growing at a more stable rate than anywhere else. In fact, we've just seen that the Eurozone finally fell into a deflationary period. So it really does look like the best. We could keep seeing these high valuations. I still think, though, given our earnings growth, we could see a lot of volatility for the rest of the year.
Well, speaking of deflation, oil prices have come down. That's knocked down energy stocks. One stock you like in a contrarian move is Occidental. Tell me why you like it.
So one, it is extremely stable. It's one of the most diversified, largest U.S. oil and natural gas across the board. So it really gets hit because of the headlines about oil, even though it has really good revenues from its natural gas. On top of it, it has a 3.7% dividend yield, so almost 4% just in income from this stock. It's incredibly undervalued. I know it's a contrarian play, but I think it could be a big winner for next year.
And you have no problems with contrarian plays because you also like IBM, which had a rough 2014, even when a lot of the other S&P stocks, Dow stocks moved higher. So why are you sticking with Big Blue?
I like Big Blue because it's really made strides in its services. So not the PCs, but in those high-end technology services. It's all about the Internet of Things. Also a really good valuation, great dividend stream, very stable stock. And in a year where I see a lot of uncertainty, I like these nice, stable companies.
All right. Thanks a lot, Erin.
Thank you.
And thank you for watching The Street.